Okay, we're going to get started. Good morning, everybody. Welcome to I think, 31st version of the Scale Leadership Series, which is going on for coming on 3 years. I'm very pleased to introduce you this morning to Chris Kane, who I had the pleasure of meeting in person when Scale was first launched in early 2019. And was actually the first ever Scale engagement that brought me to Chris Kane, the first of 350 engagements so far, which was helping a distressed ASC business in Southern California, which thankfully had nothing to do with Chris Kane. But he was, however, across the street from this organization, happily running one of the country's best dermatology businesses, West Derm. And I'm not quite sure how I found him, but somehow I realized that he was literally in an office across the street from the hotel where I was staying. And so I remember walking over to his office to sit down with him and discovered that he to this day remains one of the most talented, insightful CEOs that I've come across while at Scale. And I'm very excited that we all get to share some time with him this morning. So Chris, thank you for joining us.
My pleasure, Roy. Hi, everybody. I guess I thought it was just a matter of convenience. So I'll take the compliment.
Yeah.
Where would you like to begin?
We just stayed in touch ever since, and it's been a journey for you, and it's been a journey for me, and it's been wonderful to observe as a witness, as a bystander, all the wonderful things that you've done over the past 5 years. So let's start with your background. Let's update the group on your journey through healthcare services that's led you to here today.
Sure. So I would say if I go backwards, I'm currently the CEO of Allergy Partners today. I began that role in September. So I'm new to the role, but for the prior 2 years, I've been on the board at AP, helping facilitate the growth and the transition from a physician-led platform to a family office-owned platform. Prior to that, I was at West Dermatology from 2014, 7 years to 2021. And I was the CEO there. And when we stepped into West in early 2014, it was a very small derm group that was losing money. But we saw the clinical excellence, we saw a clinical footprint that we thought made sense from a density perspective. And we were able to successfully grow that business over time and have a wonderful exit to Sun Capital with Jefferies in the lead. So I took a year off after that, and then, of course, got back to work. And then prior to that, I was the CEO at a DME home sleep therapy business called Pacific Pulmonary. And I was there for quite some time. I actually started my healthcare career there in 2002 in the marketing team, and then went to VP of Government Affairs and spent a few years in Washington and other state capitals, of course. Then became the COO, and then we went through a transaction and sold to Teijin, which is a Japanese multinational with a very large global respiratory footprint. And after that successful transaction, I became the CEO. And then transitioned out of that role after a 3-year agreement with Teijin to lead the transition, allow them to do some things with the business around mergers and acquisitions. And then I made my way over to dermatology. And then prior to that, I had completely different careers. I was in sales, marketing, and PR for 8 years for technology businesses. And prior to that, I ran an outdoor retail business in Palo Alto, California. So a completely linear career path, as they say.
That is, I didn't know that about those other career choices. So that's very interesting. I'm gonna come back to that later. I find that fascinating. So you've experienced multiple rounds of ownership, different private equity groups. So compare and contrast between them, family office ownership. I didn't realize multinational ownership of the DME. And other ownership groups as well in your former life, maybe perhaps detail. How do they? I'm a big proponent. I'm a believer that ownership influences tremendously outcome. in the trajectory of a business, from short-term thinking to medium-term to long-term. Ownership has a huge say. How do you think about the different ownership classes that you've been accountable for, and how they've influenced you?
Sure.
Do you have favorites? Do you have least favorites? What are your thoughts?
So I would say I'll get to that last, but if I start with private equity, so I've seen a few and worked for a few, and I think the commonality in private equity, for the most part, although there are some big funds like Carlyle and others playing long game, more family office type investments, but they're still in the minority. That the big similarity I see is somewhat obvious, which is they're all on fund cycles. And depending on where you land in their cycle and how the overall fund is performing and other issues that can truly be independent of your own organization, have a huge impact on how the private equity engages with your organization. And that, to your point, ownership really does honestly drive outcomes. I mean, you can have a wonderful business and a wonderful team and still find yourself in a challenging spot because private equity, there are other dynamics at work. What's what I call the weather system in private equity, that you really can't influence. One of the big differences I see is how investors show up in the business on a kind of weekly, monthly basis. So I've worked for very hands-off investors who truly want a monthly update, and they'll be curious, they'll ask good questions, but they are not oriented on running the business or saying, let me sit in the chair with you. I've also worked for the type of investors that do want to sit in the chair with me and have very strong opinions about what to do and not to do around executive talent, around strategy. And they really have made a hallmark in their own respects by being very hands-on operators. And so of the two, my personal preference is in a little less hands-on, but I expect myself and my team to be able to lead the organization successfully, accomplish our plans, and ask our private equity sponsors for everything from capital to network guidance to strategic insight, which most of them can provide. I would contrast that. So Teijin, the multinational piece, was a completely different animal. It was a very interesting part of my career in the sense that I was traveling the world from obviously Japan to Australia to Europe, helping them build a respiratory network. So that piece of it was really educational, and I learned a lot. And I have to say that working with the Teijin's culture and the quality of the people that they have in their organization is extraordinary. So I really enjoyed working with that organization, and they treated myself and our organization incredibly well. And I would say they were much more like a family office dynamic. So, their investments, they plan to hold for 20, 30 plus years and truly build global nodes and networks. And that's exactly what they did. And our business simply was one of the nodes in the network. If I go all the way forward to today, we're currently owned by a family office that is based in Europe. And I would say I'm really enjoying working with them, first as a board member for 2 years and now as a CEO, for the following reasons. Number one, they are absolutely best in class investors across multiple sectors in the world. But they are very focused in healthcare, both in Europe, in other parts of Asia, and certainly now in the United States. And they know what they're doing. Number two, they have access to extraordinary levels of capital. So they're very deliberate about how they deploy their capital. But unlike some other, PE funds where you can find yourself, even if you have opportunities to grow your business successfully, constrained for capital or directed more towards a higher leverage option for capital. With the family office that I'm working with is very leverage averse. very interested in driving growth and have designed the business as if they will own it in perpetuity, which gives us enormous strategic flexibility and I think really a unique, significant and defensible strategic edge in the business. So let me stop there, Roy. Feel free to ask any questions or if I left some gaps.
I thought that was perfect. I mean, I get asked often by investors, what would be the competitive advantage of this asset in an otherwise saturated marketplace? And sometimes my answer is as simple as, well, perhaps you'll have a long-term time horizon, which will make you one of one. It doesn't, people overthink competitive advantage as some strange patented IP that you've discovered in a lab that no one else has. But it can be a lot simpler than that if you're willing to commit to the long term. So I totally relate to what you're saying.
I think that's right. And the other thing I would say is, at least in my opinion, in physician practice management and similar sectors, the competitive advantage is both your capital sponsor, if you have a unique strategic approach, which is very uncommon, to your point, there's not a lot of secrets out there. It's really about the quality of the team and the ability to execute at the MSO level, number one. And number two, the ability to partner with your providers in really authentic ways so that you've got very strong alignment around growth, around provider compensation. I mean, there are a lot of moving pieces, and accomplishing those alignments is not simple. But many good teams do it, and the ones that do it well tend to thrive, independent of the sector they're in.
I want to build on that. But before I do, I'm going to double back. One thing that you said, which I just want you to elaborate on a little bit. Private equity dynamics and bad weather systems. What's an example of a bad weather system?
So a bad weather system would be you are working with a private equity group or in a fund inside a private equity group that has run into difficulties with some of their other investments. And so the expectations and the desire for your investment to outperform, and oftentimes that can be, can you be much more profitable much more quickly, because they are looking at the portfolio in total and saying, okay, we've got a couple of mediocres, we've got a couple that look pretty good, and we need the ones that look pretty good to do a lot better than we really asked them to do.
Got it.
And that's a real phenomenon. I don't know if anyone on this call has experienced that, but it's not uncommon. So you just have to realize that you're one of many in a portfolio, and that whatever the macro weather system is for the PE fund with the PE firm with that fund can have huge influence on what you do. The other is, if they deploy whatever fund capital they have towards other assets, it's also not uncommon to go to your capital sponsor and say, listen, we've got this opportunity or that opportunity, and it requires incremental growth capital, only to find that it's not available.
Yeah, private equity funds running out of money is something and surprisingly running out of money, is something that anecdotally we see quite often, actually. It's an interesting one.
Yeah, they don't like to talk about it, but it does happen.
Are you the 10th acquisition of a fund, or are you the first? And big difference between being the last one in and the first one in. LIFO, FIFO. The new one that you've added just now is the undue pressure to outperform to compensate for another asset that's underperforming. Makes perfect sense, but it's not one that I hear mentioned too often. But look, these are people businesses. They're not product businesses, and the mind is influenced by all kinds of incentives. So it's very interesting. Okay, I want to broaden out the question a little bit. So there's two things going on in healthcare, right? From a regulatory standpoint and from a competitive dynamic standpoint. There's a question of aggregation, often referred to as economies of scale or diseconomies of scale. monopolistic power and influence. And from a regulatory standpoint, that's looked at across health systems, payers, and now the new entrant, corporate healthcare, which is a euphemism for institutional private equity-backed healthcare. And so on one level, a question is being asked for all three actors. Is size good for healthcare, or is it bad? And you have academic groups that are invested in just this question. And one thing that they've been focused on, in my opinion, myopically, not in a good sense, is pricing. Price goes up when size goes up. That's it, case closed. I think that's overly reductive. And I think there's lots of things that need to be looked at, including quality. The second derivative of that regulators have been focused on is private equity in healthcare, good or bad? But it's part of a larger question that they're tackling. So my question to you is, what are your thoughts on size in healthcare? What are the regulators getting right by criticizing it? What are they getting wrong by criticizing it?
Yeah, that's a big question. So keeping in mind that my career really is in the middle market, where, I mean, the first thing I would say is, even the most successful middle market organizations never aggregate to a size where they have market pricing power, in my experience. Or it's very uncommon unless they're on their way to becoming a DaVita or something like that. At which point that you have a whole different dynamic. My big picture on the regulator front around these questions is I think they've got it about half right. So I think the concerns that we're seeing are emerging around PE in healthcare are really driven by very large scale investments in sectors that have largely already consolidated, certainly much more so than the sectors that I've spent my career in. And that is where you do start to see, in my opinion, some predatory behaviors around pricing or out of network, which, there are all sorts of mechanisms that are really pricing mechanisms in disguise. I think it is reasonable to have some concerns there, but I think it's not new, right? So hospital systems have been consolidating for years so that they both have leverage with the payers, but also quote unquote pricing power, which they leverage extensively. So I'm not sure that to your point about it being overly reductionist, that you can say, fragmented is good, consolidation is bad. What I see in the middle market is consolidation takes both forms, but in the following way: it really has nothing to do about harming the patient or limiting access, at least not in the sectors I've worked in. I've just seen, for instance, in dermatology, there are still something in the neighborhood of 30 plus quote unquote platforms out there that are highly fragmented, that are likely providing very good clinical care and patient, service support, but have gotten themselves into a position where they're growing very slowly. And at that point, private equity runs into a real problem in the middle market, where they have to figure out, well, what are we going to do with these assets? And then try to bring them together in some form that both provides some kind of return, but also creates a sustainable organization. I think the risk I've seen in PE getting into the middle market and growing too quickly and literally going bankrupt and then creating all kinds of problems for patients and providers is the bigger risk. And I don't think there's a regulatory answer for that. Although certainly California is experimenting with it, right? They're really trying, they're suggesting they should get right in the middle of the corporate practice of medicine and say, yes, you can buy this, or no, you can't. So that's a different topic. But I do think that there are, obvious examples today with some of the very large PE groups where they have gotten into healthcare in ways that at least the optics are pretty negative. And I think they're inviting negative attention, but I'm not sure the solutions are really would even work in the first place. other than, trying to break up some of the majorly consolidated businesses, which I think is impractical. My bigger concern, just as a patient and a consumer myself, obviously, is the consolidation going on in the payer front. Because like, quite frankly, what I try to educate our providers on when we talk about growth is we're really not talking about creating more wealth or positive financial outcomes. My belief, strongly held belief, is if we don't achieve a certain level of scale in our markets and in the aggregate, organizations like Optum will ultimately be in a position to make it very difficult for us to run our business successfully.
Yep.
And they're playing the long game, obviously. And that's where I see the big disconnect in healthcare. You've got a lot of PE folks playing a 5-year game, and you've got the big payers who are rapidly consolidating playing the 30-year game.
Very well said. Picking up on this reference to California, I think of no better person to ask, because you've done a lot of business in healthcare business in California and other states too. How is it to invest in California healthcare these days relative to other parts of the country? Some would argue it's a no-go state. There's no way to succeed in California, and it's only getting worse. Is that a hyperbole, or is that an accurate description of the reality in California?
I think it depends on your goals. So if somebody said I would never invest $1 in California, I would, first of all, I'd probably be somewhat sympathetic because they're going to have a couple of good reasons, everything from labor laws to now the new, what I would call adventurism on corporate practice of medicine. In my experience, we have thrived working in California. The market is obviously quite large. It's very heterogeneous. So there is no such thing as California as a market. You find yourself actually in regional markets. And we have, particularly in the dermatology business, we had 50% of our patient base and a little more of that in revenue, both in cosmetic and general medical derm, in California. And we did very well. But you have to, if you are looking for a state where things are just simpler, right? So for instance, what I often hear contrasted to California is Texas. So generally low regulatory environment, very large markets, and no income tax, et cetera, and labor laws that are definitely business friendly. So in my belief that you can adapt your business to grow in large markets very successfully, I wouldn't not be in California. We are now, and we're going to continue to grow here. Is it our easiest market? No. But you cannot beat the growth opportunity. And quite frankly, what's interesting about California too is somewhat like Florida. It's been a laboratory for new approaches to payers. So whether it's IPAs or capitation, or a lot of those things have been tried on for size out in California. Usually the word capitation makes people run for the exits in middle market. But I can tell you that both in Nevada and California, we ran extremely effective capitation agreements that were a win for the payer and the patient and for us financially. So it just takes a different level of execution. That's where I would land on California.
So what's understated in California is levels of demand, market opportunity, and in some cases, levels of reimbursement, the rewards for actually delivering good service, which can often more than compensate for the administrative nightmare, headache, burden that comes with conducting business in California. Is that fair?
Yep, that's it. And the other is that actually the payer environment in California is much more fragmented than it is in some other states, which creates its own opportunities.
It really does. There's a very big point that's often understated, right? Those other states, one after the other, 50, 60, 70, 80% dominated by a single payer.
Correct. Like
That's
North Carolina and Blue Cross Blue Shield is a perfect example. I mean, they're the 10,000-pound gorilla in North Carolina.
very
And
good. And then you are reminding me every time I was with a client in California, and there is no one California. And
no,
you speak about northern parts of California to Southern California, and they think you're talking about a different country.
well, and even with it, I mean, we lived in Northern California for 25 years, and then we now live in Southern California. I mean, they are quite different, as you can imagine. But even within those sort of general references, quite frankly, California, like most big states, is highly regionalized,
Yep.
and that creates a lot of business opportunity.
Yep. Very helpful. So let me move on to the clinical specialty focus. So you've been now in two, to simplify, because I know derm also included aesthetics as well, but between dermatology and allergy, let's call it allergy. Can we include ENT as well, or pure allergy? Pure allergy, right?
Yeah, we do not do ENT, but
Yeah.
obviously the services to patients cross over, and the patient populations are adjacent if you think about it from a Venn diagram.
Yeah.
But the nature of the services are really completely different.
So if we think about comparing similarities and contrasting differences between derm MSO, the derm ecosystem, and the allergy MSO and the allergy ecosystem, what are some of the similarities and differences that come to mind? What feels the same? What feels totally unique?
Yeah, I'd say the similarities are, in terms of the need to partner with your providers, and I'll get to what that looks like in a moment. That is absolutely job one in both sectors. So, there is no such thing as running a successful PPM where you are not working in lockstep with your providers on growth. And that's everything from why are we growing to how do they participate, et cetera. And that has a lot of nuances in it. So the other similarity I see is generally what I would call a scarcity mindset. So providers in both of my organizations tend to approach the world as if I have a 9-month patient backlog, I'm not thinking too hard about what impact that's having on the patients. And it gives me some comfort as a provider that I know I have all those patients waiting to see me.
A full waiting room is a good thing, even though the poor schmuck who arrived last is in for a very long wait.
Right. And then there's the virtual waiting room of, like, if it's taking months to get an appointment, changing the mindset from scarcity to abundance and saying, we happen to work in sectors, both derm and allergy, that have a tremendous supply demand imbalance. And so, in our organization today, we have many thousands of patients waiting to get an appointment with us. I mean, it's really a lovely problem to have to solve. So I tend to view both sectors as the challenge for the MSO is to create the capacity to meet the demand. And that means you have to work with physicians to say, we're going to add another doctor or another mid-level or whatever the decision is to meet this latent patient demand and do a better job of serving the patients that want to see us, whether they're existing or new. And in so doing, we will grow, and you're not going to lose out in any way, shape, or form. The other similarity is in both of my organizations, our providers had a meaningful ownership stake, which is crucial to long-term alignment. And so you typically have to have two conversations at once with a provider. One is really about their, cash compensation. What does that look like? What does income repair look like if they sold a piece of their income to the MSO, which they all do in some form? And what's the value of their ownership stake? And how do you create a holistic conversation so the provider understands both the near term and the mid to long term? And absent that understanding, most providers that I work with will default to the near-term cash comp concerns and really undervalue their ownership stake. And then I think the last piece where there are real differences is the business model matters. So in dermatology, we owned 100% of the clinic, and our physicians were employed by the MSO slash LLC. In Allergy Partners, we have a different model. And so our physicians own a meaningful piece of the company, and they also have a significant amount of clinical autonomy to run their practices as they desire. Both models have pros and cons. When we were running the practices on behalf of our derms, if we didn't do a really absolutely incredible job, and believe it or not, some days we really messed stuff up, then it really damaged the relationship and you had to go into the repair mode. In Allergy Partners organization, it's much more of a influence and alignment with our providers to say, if you wish to run your organization, meaning typically your clinic, sometimes it's 2, 3, 4, 5, and you're not running them particularly efficiently, which impacts the provider's income, then allow the MSO to come up next to you. Let's partner on this and let's run this more efficiently. So that's where I see a lot of the commonalities. I mean, I think the differences have everything to do with the intensity of the services being provided. So obviously in general dermatology and some cosmetic derm, it involves medical surgery of a certain nature, et cetera. Allergy, of course, does not. We did not use ASCs at West Derm, but some derms do. But obviously out in allergy slash ENT businesses that are a hybrid, the ASC piece of their business is a meaningful element. Not only is ENT obviously more surgically intensive, but it also has much more, per patient higher value because of that. And you get facility fees, which you don't appreciate at least we didn't in Durham and West, and we don't as an allergy business. So that's where the sectors start to depart from a business model perspective. The difference is in general derm, we had a lot of success maintaining and recurring patients so that there was a bit of an annuity revenue for our business. If we did a good job with the patient and kept them coming back when it's clinically appropriate, it was very successful. We do the same thing at Allergy Partners. In ENT, that's much more difficult because most patients are coming in for a specific medical procedure that hopefully, absent, complex cancer cases for that patient, it's a one-time, they're done. And maybe you'll see them obviously as a follow-up, but you may never see them again as a patient for another service. So that's where the operating models start to diverge. So let me stop there, see if that was helpful.
Yeah, look, you're reminding me of my ENT, who is an amazing physician. He performed a miraculous procedure on me that cleared up, doesn't sound like it this morning, but it cleared up my chronic allergies. Just performed surgery on my sinus. And that was, I don't know, 15 years ago. I haven't seen him since. I don't
And
expect
I'm hoping, I bet you don't want to.
I love it. He's amazing. I think on the list of physicians that have helped me in life, he's probably number one. But my reward for him is never seeing him again, which is an interesting business model.
Yep, that's it.
Very good point. So what gets you excited about allergy and ENT for Allergy Partners specifically, and your family office, and for allergy ENT as an industry?
Yeah, good questions. So I think, if I think about the sector, I'll just start with allergy because although they often get smushed together, they really are very, very different, on the ground clinical experiences and organizations to run that just happen to have some patients that overlap. So it's not unlike derm around gen derm and cosmetic. What I like about our sector is it is extraordinarily fragmented. So we are arguably the largest platform in the United States in allergy, whether you measure that by patients or clinic sites or providers. And in any given market, we're no more than 3% of that market. So that presents us with a lot of, to use a phrase, I can't believe I'm going to say this, but greenfield for growth. Number one. Number two, unlike other sectors that I think, investors viewed as more accretive, allergy has not attracted an outsized amount of investor interest. And so there's just less competition at the moment. And that is always welcome if you can offer something unique to the market. And, at some point in my experience in derm, the bidding frenzies got so high, we were offering 6Xs on really great groups, and someone would come in and blow us away and pay an 11X. And, at that point, the math goes upside down, in my opinion. And you don't see any of that behavior in the allergy space, and nor other than certain little pockets in the ENT space. So I think for really sharp consolidators, and there are a few, particularly on the ENT side of the business, there's a lot of opportunity for growth for many years. And the regulatory pressure on the space is moderate, but not high. And a lot of that has to do with the efficacy of the therapies is well demonstrated. In the relative scheme of healthcare, they're very low cost. And that provides a sense, that's, the regulatory environment is its own weather system. It's pretty calm in the allergy sector, which is great, because if that changes, of course, the nature of your entire business, can change overnight. So that's what I see. And I think that the permanent, if I'm just with my business hat on, it's really a privilege to be in a business where the biggest challenge we have is we have many more patients to serve than we have capacity to serve. And solving those problems and how we do it creatively, I find very energizing. And we have a number of things we're trying, in our business, everything from, telemedicine to the use of mid-levels, et cetera. There are a lot of hybrid approaches that we are piloting at the moment to create access where it's difficult to do so, meaning our clinics are full and there's, we have to open a new one to create access. As well as just getting the organization focused on the patient is what matters. And if we are successful at creating access and then delivering quality healthcare, that will give us an edge across the entire sector, and particularly in our payer negotiations. Because that's what even under consolidation, the degree to which it's already occurred, payers are still dependent on large regional medical groups that provide access at, good to excellent levels of quality, which obviously the measure for that these days is MIPS MACRA for most. So let me hit the pause button there.
So if I was to list to you a few major themes, trends in healthcare that are affecting most, from the growth of virtual care, telemedicine, growth of mobile care and home care as a new site of service, which is connected to virtual care, the emergence of value-based care, the consolidation of payers into payer providers, the emergence of data analytics in healthcare, and the growth of real-time reporting, automation, improved outsourcing, and lastly, the challenges of shortages in clinical supply, labor supply, and creative ways to address that. Which of those themes do you think about most? Which is most exciting to you? Which is most threatening to you?
The two we think about the most are the payer provider integration. So the pay-vider phenomenon, because I think that has the largest head start. And I mean, it's almost in plain view, Optum has become the largest employer of physicians in the United States. Right. And it's almost as if no one talks about it. And so, they have been steadily executing a model to disintermediate any third-party ownership, whether it's physician partnerships, much less private equity, and methodically fold it into their own network. So that is what we think about, not just Optum in particular, but that to me is the biggest threat to standalone independent platforms, independent of who owns them.
It's a fair, everyone by comparison to Optum is independent on a relative scale.
Sure.
Yeah.
That's worth a chuckle. So we think most about that, and we think most about building density in our core markets, both for operational benefits, which are pretty obvious, but also for payer dynamics. So we try to get as big as possible in, very narrow regions where we actually have leverage in our payer negotiations, independent of which payer it is. But, the vast majority of our business is commercial, and the vast majority of that, of course, is with, some form of a BUCA. I think where we have a lot of optimism is around data analytics and AI. And what's really interesting about it for allergy is that one of the, like other sectors, there are not clear outcome measures for an allergy patient. And there's a lot of interesting work going on, everything from rapidly improving sort of allergenic medicine through the use of data analytics, and to some degree AI. It's still AI is a smaller piece of that today. And the other is simply creating, as a sector, clinical pathways with clear outcome measures where you can, outside of MACRA and MIPS, actually demonstrate to whomever is paying the bill, certain pathways that may or may not be unique to a particular organization lead to sustainable outcomes. And a sustainable outcome in allergy is defined as X, right? Depending on the patient's condition and the therapy. So everything from biologics all the way through to, shot therapy or sublingual. So we see the opportunity to capture emerging therapeutic paths, because there is a lot of innovation going around in allergy, trying to move away from shots for obvious reasons, because they involve needles, to other forms of therapy like sublingual, you name it, that are proving to be rather efficacious. And there's a lot of emerging work on food allergies and effective therapies for food allergies that are in their infancy. So we're excited about a lot of that. In our business, the opportunity for virtual care is moderate. So there are particularly patient follow-ups that we do virtually. And so we do utilize telemedicine for that. We have not yet landed in a place where we think that telemedicine would be a disintermediation platform for allergy, although there are businesses out there with that strategy at play right now. Like many sectors, we see it as a hybrid. So it is an adjunct to our clinical business, but we don't see, like, if I really leapt into the future, trying to be a completely virtual allergy business is not something that is part of our strategic focus. And then value-based care.
Keep going.
No, I was just going to say value-based care, we think about a lot.
I forgot my own list, but you keep going.
No. I just wrote it down. Value-based care, we encounter it. We do not have any VBC agreements at the moment. Part of the reason for that is that no one knows how to measure an outcome for an allergy patient. So it tends to get a little circular. And a lot of the value-based care, while some of those agreements can incorporate allergy, our sector's not a focus for those yet. And it's, we're in some brainstorming conversations from time to time around, could we do this? Really, what it looks like for us is we've had payers approach us on a capitation basis, which is not value-based care, but it's sort of softly adjacent. But even those aren't particularly well thought out on the payer front yet. So
Right, they end up being very cost driven, which is not necessarily the same thing as efficacy at all.
correct. And quite frankly, I mean, allergy is relatively low cost. So we don't find I mean, ENT is different because of the, ASC and the intensity of some of the surgeries, et cetera. But in allergy writ large, there's just not a payer focus on, or, macro concern on cost.
But still, as a business, as a market, as an industry, this concept of finding efficacy as a business opportunity, when you compare and contrast it with other industries like fashion, right? You think about the different dimensions that you can, again, this point of competitive advantage, differentiate yourself. We mentioned time horizons as extremely low-hanging fruit that very few people get to pick, but it's there. Another one in healthcare, depending on the clinical specialty, but true for all. What's amazing is that in many cases, the clinical specialty is presenting itself to you as, I think of things in terms of baseball. I don't know why. That's my attempt to try to sound American. But in many specialties, we're in the first inning of efficacy. So I won't use Greenfield. I'll use Blue Ocean. That's a lot of blue ocean.
Okay. Yeah, I almost want to say white space, but then I'd have to hang up. So
we're gonna hang up soon.
yep.
All right, so I want to leave time, as we always do, the last 10 minutes for the group to ask any questions, Chris. But I personally want to thank you for answering all of my questions. That was fantastic. Any questions from the group? I'm going to give it 10 more seconds. I'd be shocked if no one asks a question.
Hey, good morning. This is Carl Friedrich.
Good morning, Carl.
Really appreciate the insight this morning, and I can identify because I had a period in my career where I worked for a family office that was funding a healthcare venture, and I appreciate the longer view. In your opinion, companies that take that longer view as investors versus companies with a more short-term or mid-term view, do you see ultimately a dominant model, or are they sort of symbiotic and will always coexist, and just recognizing the characteristics of each investor is something you need to be aware of?
Yeah, I think it's the latter. I mean, I have certainly, in terms of a dominant model, I don't think one will push the other out of, the ability to invest in assets. I certainly have my strong preference that I think the benefit, and family offices are, if you've met one, you've met one, right? So you have to make sure you understand what the office's investment thesis is, et cetera, et cetera. But in general, what I'm seeing is family offices do play the longer game. They typically will put more capital to work in the business, which, quite frankly, is a huge asset as a CEO, not just for M&A, but for improving the MSO infrastructure, being able to hire best-in-class talent. When you're working with investors that aren't thinking about, if you're in PE, even if you're early in a fund, my experience is year 1, year 2, year 3 is really your window. And because in year 3, they already start thinking about selling. And then in year 4, you're busy trying to sell. And then suddenly year 5 comes along. And so you really have this hyper compressed period of time to work on the business, whatever that looks like. And I just think, and hopefully this is consistent with your experience, Carl, but I really enjoy working for a family office. It is it's refreshing, and B, it creates new opportunities in the business to think strategically.
Yeah, I think maybe also it's a characteristic of the family offices. What else are they investing in, and what's their philosophy around those investments? In my experience, it was essentially a real estate they invested in real estate, which by definition has kind of a little bit more patience, if you will.
Yeah.
and understanding that assets appreciate over time, and that in healthcare, I think that's a good way of thinking about things, because you hire a whole bunch of doctors today, they're not going to bear fruit for 18 to 36 months in most cases. And you have to understand that when you get in. So it's valuable insight to kind of think about as we manage PE companies.
Completely agree.
Thank you.
Any more questions?
Chris, I have a question. This is Ben Anderson. And thank you so much for the great presentation. This was very educational and informative. But as you're thinking about early stages of an MSO, what was kind of the most important value proposition that you put forth to new partners or new practices you were looking to bring on? Kind of the one that seemed to hit home the most.
That's a really good question. It was variable, but if I tried to generalize, I mean, the first rule of the MSO is don't screw it up. Right. So it's almost the inverse of a value proposition, which is we're not going to come in and blow up your clinic. Number one, I think if I really thought about it in terms of long-term strategic value, it was RCM. So the ability to collect on their behalf, typically in a way that was much more efficient than they were able to do. Number two, IT support. So, PM, EHR, essentially getting them best in class systems, which most smaller groups do not have. And then I think third would be, and it was highly variable, but third would be, contract lift. So if you're able to bring somebody in onto your tin and give them, better rates, well, you just gave them a raise for showing up. But those would be my three.
That's very helpful. Thank you so much.
Chris, the beginning of the conversation, we talked a lot about competition and market structure and discourse around both those topics that really have a potential to shape the future of the healthcare landscape. And as someone who's been in healthcare, maybe not your whole career, but certainly a large portion of it, and as someone who's been a CEO of large platforms and small platforms, so you've experienced the industry from a number of different perspectives, and you have a personal vested interest in the industry. How tangibly important, really measured by allocation of time, is getting this public discourse right to a CEO in healthcare? Is it something that's more academic and removed from your day-to-day as a CEO, or is it something that a CEO really should take interest in contributing, correcting the public discourse on the topic?
That's a great question. I think it's very important that I think if I use myself as an example, we were very active in Washington, D.C. in both of my last organizations. And most of that was at the regulatory level, as you might expect. However, we created a coalition of the top platforms in derm. And the purpose of that coalition, which McDermott Will helped us, pull together and manage, was really educational and explaining, for instance, the value of a Mohs surgery, or, other areas of derm where there was concern, or there was this drive, to Roy's point earlier, around, well, why don't you just do excisions on everyone because they're a little bit cheaper? And, being involved in an educational effort where you took some of those ideas, I'll call it an idea, and took them head on and said, well, listen, private equity is not, some giant hegemon out there. It's actually completely heterogeneous. And I have a strong belief that, hopefully doesn't sound too self-serving, that a lot of private equity, certainly in the middle market, is actually improving healthcare by creating MSOs that run the organizations better, creating capacity, et cetera, et cetera. But I think, Jason, to your meta question, I think it's important. And I would say, if I made up a number in any given year, I'd probably spend 5% of my time on it, but that would be very meaningful time. And the question becomes, like, where do you spend the time? Because otherwise you run the risk of just shouting out a window, if that makes sense.
Thank you. Very helpful.
Chris, you definitely gave away your origins, your West Coast origins, when you used words like meta. Definitely not an East Coast word.
Sorry, I'll say wicked later.
No, but those sentiments we agree with 100%. We think an ownership class, by definition, is going to be heterogeneous. It's people, and different people do different things. There are influences, sure, but there's as much variance as there is commonality. And if we were to generalize, our view of private equity healthcare is mostly positive. I want to thank you for your time this morning, and I think that the benchmark for us, the goal for us in these interviews, is always to feel like this was the best one yet. And I recognize that actually gets harder and harder the longer that we do this for. But I do have good news for you. This is definitely the best one yet. So I really appreciate the time.
Well, I'll take the flattery, whatever I can get. Thank you, Roy. And thanks, everybody.
Everyone,
Have a good day.
Thank you so much, Chris.
Take
Appreciate
care.
it.
Bye.